Welcome to part 2 of the Trading Psychology course. In this final part, we move into the chapters that complete the full psychological framework for consistent trading performance. We begin with the first chapter of part 2, Trader Identity, Casino Player or Risk Manager. In this chapter, you will see why some traders approach the market like gamblers, chasing excitement and quick results, while others operate like professionals, focused on risk control and long-term survival. Your identity shapes every trading decision you make, from position size to emotional control. By the end of this chapter, you will be able to recognize your current trading identity and start shifting toward the mindset of a disciplined risk manager. So if you enjoyed this video, make sure to like it, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Let's start with something most traders never think about: identity. Most traders focus only on strategies. They believe if they learn one more indicator or one more pattern, they'll finally become consistent. But here's the truth. Strategy is only the surface. The real driver is invisible. It's the identity you bring to the screen. Two people can learn the exact same setup, read the same books, even trade the same chart, and still, one will grow his account while the other slowly blows up. Why? Because it's not the setup that makes the difference. It's who you are when you execute it. Identity is that inner story you carry into the market. It's the voice inside your head when things get uncertain. For some traders, it says, "I have to be in a trade right now." For others, it says, "My job is to manage risk first." And that voice decides everything. Whether you respect your stop or move it just this once. Whether you follow your checklist or throw it out the window. Mark Douglas, in Trading in the Zone, explains it perfectly. Consistency doesn't come from predicting the market. It comes from thinking in probabilities, from knowing that one trade doesn't define you. And you can only think that way if your identity is built around being a risk manager, not a gambler. Some traders enter the market seeking excitement without realizing how much that mindset sabotages their results. This contrast in identity between those who seek consistency and those who crave thrills is exactly what Dr. Brett Steenbarger highlights in the following video.
I would say two self-destructive behaviors come to mind immediately. The first I would call trading addiction. People can be addicted to trading just like they can be addicted to gambling, and for much of the same reason. Not everyone trades to make money. Some people are trading for thrills and excitement, and those people do get in their own way. And much of the money that's made in trading is by being patient and waiting for your edge, waiting for your opportunity. If you have the need for thrills, you won't have that patience. You won't wait for your opportunity, and you get in your own way. The other self-destructive behavior I would call impulsivity. When people make impulsive decisions because of frustration. They lose some money, the market's not moving very much, they become frustrated, and out of that frustration, they feel a need to trade. In fact, traders call it over-trading. They make those impulsive decisions where they don't really have an edge in the trade, and they end up losing money as a result. My rule of thumb is if you're thinking about yourself or you're thinking about your profit and loss, you're in the wrong place. You should be market-focused, not self-focused. But if you don't have a relatively quiet mind, you can't access those intuitions. When traders are frustrated, they're thinking about their profit and loss statement. They're not really focused on markets. And as a result, their impulsive decisions aren't based on instinct. They're based on emotions.
This clip reinforces a crucial truth. Sustainable trading comes from discipline and identity, not excitement. Now, let's talk about the casino player mindset. This trader comes to the market for excitement. Flat exposure feels boring. They want to be in a trade. They want action. They want that rush. For For them, trading is not about probabilities. It's about stimulation. And here's the science behind it. Studies show that the brain releases dopamine, not only when we win, but also when we're about to win, when the outcome is uncertain. That's the exact chemistry casinos exploit with slot machines. And the same thing happens in markets. The casino player is hooked, not on profits, but on the emotional high of almost winning. You can see it in their behavior. They increase size right after a win because they feel invincible. They jump back in after a loss, desperate to make it back. They trade headlines, rumors, anything that promises a quick move. And if the trade goes against them, they start moving the stop further and further, hoping the market will turn. Emotionally, it's the same cycle every time. A spike of excitement when they enter, anxiety as the trade moves, relief or euphoria when it closes, and almost immediately, the craving for the next hit. The market becomes a slot machine with candles instead of reels. And here's the problem. The casino player escalates risk exactly when variance is highest. Big after wins, reckless after losses. Sooner or later, one trade wipes out weeks of effort. The identity of a gambler always leads back to the same place, giving it all back. Some traders chase adrenaline. Others focus on survival. In the next clip, Larry Williams, who has worked with over 100,000 traders worldwide, explains what separates those who make it from those who don't.
I worked with probably 100,000 traders and investors literally throughout the world. My books are in every major language of the world. And I really looked and worked with these traders to see what separates, what makes a really successful winning trader. And you know what I think I've seen in all of these people? They're absolute survivors. Some are not what you would call particularly intelligent. They're not bright. They're not gifted mathematicians. They may have a background like mine in journalism and writing, or they might be a car mechanic. Or they come from all walks of life, but they just have that strong desire to survive. I don't know quite where that comes from. I don't know quite how to teach that to you or how you can become that, but it's something I think you need to have as a model. It's all about survival, not losing your money, staying in the game, not betting big, so of course you can stay in the game, but you increase your ability to survive and you're going to become a much better trader or investor.
In the end, it's not brilliance that keeps you in the game. It's survival instinct, the opposite of the gambler's mindset. Let's continue. Now, let's look at the opposite mindset, the risk manager. This trader treats capital like inventory. Their first job is not to predict the next tick, but to control risk and keep the business alive. They don't need constant action. They only take trades that fit their plan. Before they enter, they already know the answer to two questions. How much am I willing to risk? And where is this trade invalid? Once those answers are clear, emotions lose their power. The stop is placed, the size is fixed, and the outcome is just part of the process. Think of other professions that deal with risk. A pilot doesn't take off without a checklist. A surgeon doesn't cut without sterile instruments. An engineer doesn't build a bridge guessing the weight it might hold. In each case, one small mistake could cost everything. That's why they follow protocols. That's why they train to manage risk first. And a professional trader is no different. The risk manager doesn't think in terms of one trade. They think in series. They know that over 20 or 50 trades, their edge will play out as long as they stay consistent. And that's the key word, consistent. Not perfect, not exciting, just steady. And this calm shows up in their emotions. They're not chasing the thrill. They're not panicking when a candle spikes. They accept the cost of doing business, one trade at a time. And because of that, they avoid the giant loss that destroys gamblers. Over the long run, that difference changes everything. This mindset of simplicity and consistency is exactly what Al Brooks uses to navigate dozens of trades each day, with a structured, rules-based process.
To me, I'm a day trader, and I consider about 40 trades a day. On the E-mini, there are 81 5-minute bars every day, and on an average day, there are about 40 potential setups. So I'm thinking constantly. And for me to be able to process whether or not I should take a trade and then place the trade and do everything correctly, I have to have a bunch of rules that keep things simple. And one is limiting my choices to two things. So risk on, risk off, bull trend, bear trend, trading range, high probability, low probability. I categorize everything that I see into a binary decision. And once I make a decision, for example, if it's trend versus trading range, if it's a trend, I'll look to swing more of my position. If it's a trading range, I'll look to buy low, sell high, and scalp. So it determines how I want to trade. If the trend is up, I want to buy. If the trend is down, I want to sell.
Clear rules, binary decisions, consistent execution. That's what risk management looks like in practice. Let's keep going. Most traders are not 100% gambler or 100% professional. The truth is, you're usually a mix of both. Some days you trade like a risk manager. Other days you slip back into the casino player. The goal isn't perfection. The goal is to shift your center of gravity toward the professional side. And that shift starts with clarity. You need to know your role. If you tell yourself, I'm here to make money today, you'll feel pressure to force trades. But if you tell yourself, I'm a risk manager, my job is defense first, everything changes. The way you size your positions, the way you set stops, even the way you handle losses, all of it follows that role. Second, you need the right environment. A clean chart with your stop and risk marked is a trader's cockpit. A checklist on the screen is a reminder of what matters. And removing distractions, like news feeds that trigger FOMO, is part of protecting that identity. Finally, you need language and rules that support who you want to be. Replace I hope this bounces with if my plan is valid, the setup will trigger. Replace I need to win it back today with my max loss is 2R. If I hit it, I stop. These small phrases keep you aligned with the identity of a risk manager. Identity isn't a trick. It's the foundation. And every time you choose the language, the environment, and the role of a professional, you weaken the gambler inside you. Step by step, the casino player fades, and the risk manager takes control. All right, let's wrap this up with a simple but powerful exercise. I want you to take just 15 minutes today and write what I call your trader identity declaration. Keep it short, keep it bold. Start with one line that defines who you are in the market. Something like, I am a professional risk manager. My job is to protect capital and execute my edge with consistency. Then underneath that, write a few clear rules that flow from that identity. For example, you might write something like, I risk the same fixed amount on every trade. Or maybe, I never widen a stop once I'm in. Another one could be, I stop trading if I hit my daily loss limit. And of course, I only take setups that pass my checklist. Print it out or stick it on your screen where you can see it. And here's the key. Read it before your first trade and again after your last trade. Do that long enough, and it won't just be a reminder anymore. It will become who you are. Because at the end of the day, your strategy is just the vehicle. Your identity is the driver. If you show up as a gambler, even the best system won't save you. But if you show up as a risk manager, even a simple plan can take you a long way. Now we move into the next chapter, risk and reward, thinking and probabilities. In this chapter, you will learn why thinking in a series of trades matters more than predicting the outcome of a single trade. We will break down how to define risk in a consistent way, measure reward using R multiples, and build a mindset that accepts uncertainty as part of the process. Because this topic is foundational, it's divided into two parts. Part 1 focuses on accepting risk before entry, sizing positions correctly, and thinking in R instead of dollars. Part 2 shows how to calculate expectancy, test your edge across a series of trades, and use simple tracking to support long-term consistency. By the end of part 1, you will know how to define your risk, read your results in R, and prepare for the expectancy work in part 2. Before we talk about probabilities, there's one thing you need to understand. You must accept the risk before you enter a trade. I know it sounds obvious, but this single habit separates amateurs from professionals. Most traders click buy or sell because they hope it'll work. Professionals do it knowing exactly how much they're risking, and they've already accepted that amount before they click the button. That changes everything. It turns an emotional decision into a professional one. Accepting the risk means 3 simple things. First, your stop loss is defined by structure, not by emotion. You're not moving it because you feel nervous. Second, your position size matches your account and your stop distance. You're not guessing how many lots or shares to take. And third, the money you're risking is small enough that even if this trade loses, you can take the next one without hesitation. When those 3 pieces fit together, you stop reacting emotionally to the market and start managing exposure like a professional. Let's make this practical. Imagine your account is $10,000 and you decide to risk 0.5% per trade. That's $50 of risk. If your stop is 25 pips, each pip must be worth $2. That's your position size. If your stop is 10 cents on a stock, you adjust the number of shares so a full stop equals those same $50. You're no longer focused on how much you can make. You're controlling how much you can lose. And that single shift is where professional trading begins. See what's happening here? You're removing hope from the process. You're not trying to avoid losses. You're planning for them. Once the risk is accepted before you enter, a stopped-out trade isn't a failure anymore. It's just a planned business expense, something already calculated and expected. You take the loss, log it, and move on with a clear head. That calm state of mind, that sense of control, is what builds consistency. It allows you to take the next trade with full confidence, without revenge, hesitation, or fear. And once you master this mindset, you realize something powerful. Success in trading doesn't start with winning. It starts with accepting losses. Once you've accepted the risk, it's time to change how you measure it. Forget about dollars. Start thinking in R, your unit of risk. 1 R is simply the amount you decided to risk on a trade. If your stop equals $50, that's 1 R. If the trade hits your stop, you lose 1 R. If it moves twice that distance in your favor, you win 2 R. It's simple, but this small change completely rewires how your brain sees a trade. When you think in dollars, every trade feels emotional. A $50 loss feels personal. It stings. Your brain sees it as danger, not data. That's why traders break their own rules after a losing streak. But when you think in R, you detach from emotion. You stop seeing the trade as money lost or gained and start seeing it as part of a process. One event in a larger series where the math matters more than the moment. Here's a quick example. You take 10 trades, each risking 1 R. You lose 5 of them, all at minus 1 R. And the other 5 you win at plus 2 R each. Do the math. 5 losses equal minus 5 R. 5 wins equal plus 10 R, leaving you with plus 5 R overall. You didn't have to predict which trades would win. You just kept your losses small and your winners bigger. That's professional trading. It's not about being right. It's about creating an edge where the size of your winners outweighs your losers. When you use R, everything becomes easier to compare. You can look at setups in Forex, stocks, or crypto and evaluate them in the same language, risk units. One setup risks 1 R to make 3 R. Another risks 1 R to make 1.5 R. Instantly, you know which has the better potential. You don't need to think in dollars or pips anymore, just R. So next time you plan a trade, don't say, I'm risking $50 to make 100. Say, I'm risking 1R to make 2R. It may sound small, but it's huge for your psychology. When you think in R, you stop chasing outcomes and start focusing on execution. You stop trading for money and start trading for consistency. And that's where real progress begins. Now that you're thinking in R, it's time for the next mental shift, from predictions to probabilities. This is where real traders separate themselves from dreamers. Most people enter the market trying to guess what will happen next. They look at a chart and think, this trade has to work. But professionals don't think that way. They know no single trade defines them. Their results come from how their edge performs over a series of trades. Prediction thinking sounds like, this setup looks perfect. It's definitely going to win. Probability thinking sounds very different. This setup fits my rules. I'll take it, accept the risk, and let my edge show up over the next 20 trades. Feel the difference? One is emotional and attached to a single outcome. The other is calm, logical, and focused on the long game. That shift alone can save you years of frustration. Think of a simple coin flip game. Heads, you win 2R. Tails, you lose 1R. You'll lose often, sometimes 5 or 6 times in a row, but the math is still in your favor. Even with a 40% win rate, you'll end up profitable because your winners pay more than your losers cost. That's trading, a game of probabilities, not predictions. Your job isn't to win every flip. It's to make sure your reward is always larger than your risk. And to play enough rounds for the math to work. Once you understand that, everything changes. You stop obsessing over one trade. You stop thinking, I need to win now, and start thinking, I need to follow my plan consistently. You stop reacting to every candle and start managing your system. The moment you do that, emotions lose their control over you. You stop trying to be right and start aiming to be consistent. And that's what makes you profitable. If your system has a positive expectancy, meaning your average trade result is positive over time, then you don't need to stress about any single outcome. One trade is meaningless. 20 or 50 trades reveal the truth. That's where probabilities live. Each time you follow your plan, you give your edge a chance to work. Each time you break it, you interrupt the math that could have helped you. This is what Mark Douglas calls thinking in probabilities. He said that traders who accept uncertainty stop fearing individual outcomes. They know anything can happen, but they trust their edge to play out. That trust gives them calm confidence, the kind that lasts even after losses. So from now on, stop asking, will this trade win? And start asking, does this setup fit my plan? If it does, take it, manage the risk, and let the math do its job. One trade doesn't matter. What matters is the series, the repetition, and your discipline to stay in the game long enough for probabilities to reward you. Every trader loves winning streaks, but what truly tests your mindset are the losing ones. No matter how good your strategy is, drawdowns are inevitable. You can have a solid edge and still go through 5 or 6 losses in a row. That's not failure. That's statistics at work. The real question isn't if you'll face a losing streak, but how you'll handle it when it happens. Let's put this into perspective. Suppose your system wins 40% of the time. That means you'll lose 6 out of 10 trades. Losing streaks will happen regularly. It's part of the game. What makes the difference is your risk per trade. If you risk 2% and lose 6 in a row, you're down around 11%, enough to shake your confidence. But if you risk only 0.5% per trade, that same streak costs you about 3%. It's uncomfortable, but manageable. That's the power of small risk. It keeps you calm and in the game long enough for your edge to show up. Most traders overlook this. They obsess over entries, indicators, and patterns, but ignore the psychology of preservation. Professionals think differently. Their main goal isn't to make money fast, it's to stay in the game. Risk management isn't about being cautious, it's about being realistic. The smaller your risk, the easier it is to stay detached from any single outcome. The less you panic, the better you execute. And that calm execution is what compounds into long-term growth. Think of trading as a long series, not a single event. You're not trying to win today. You're trying to stay consistent over hundreds of trades. Every time you cut your risk, you buy yourself more chances for your edge to appear. That's why professionals think in terms of R, not dollars or emotions. They even set daily or weekly loss limits, like stopping for the day at -3R, or for the week at -6R. Those boundaries protect both their money and their mindset. So next time you hit a losing streak, don't panic and don't double your size. Remember, drawdowns are part of the math. Step back, breathe, and remind yourself. Small risk equals freedom. Freedom to take the next setup, to stay disciplined, and to let probabilities do their work. That's how professionals survive long enough to win. Now that you understand risk, let's talk about the other side, the reward. This is where many traders lose focus. They plan stops with precision, but set their targets on hope. They think, maybe price will keep running, or I'll take profit when it feels right. That kind of thinking kills consistency. In professional trading, reward isn't emotional. It's logical and based on what the market is likely to do, not what you want it to do. Every target should have a reason: structure, liquidity, or key price levels. For example, you can place your take profit near a previous high, a fair value gap, or a supply and demand zone. Those are logical areas where price often reacts. That's where professionals take profits. You don't pick random numbers. You let the chart tell you where it makes sense to exit. It also helps to scale out in partials using R multiples. You might take a portion at +1R to cover costs, another at +2R to secure gains, and leave a smaller part running toward +3R or the next liquidity pool. This keeps your balance between safety and potential. You're protecting capital without cutting winners too soon. And over time, that habit keeps your emotions stable and your equity curve smooth. The key idea is simple. Your average winner must be bigger than your average loser. If you risk 1R and only make 1R, you'll need to be right more than half the time just to grow, and that's tough. But if your average winner is around 2R, you can be wrong more often and still end up ahead. That's the math behind consistency. A positive expectancy where your average gain per trade beats your average loss turns trading from luck into logic. Remember, your edge doesn't come from prediction. It comes from asymmetry, risking little when you're wrong and making more when you're right. That's why professionals don't chase massive wins or dream of doubling their accounts overnight. They focus on small, structured gains repeated with discipline. Because over time, the math always rewards patience. The traders who last aren't the ones who dream big. They're the ones who plan smart. So before every trade, ask yourself, is my target logical? If it's not, adjust it. Trade with structure. Trade with reasoning, and let the probabilities take care of the rest. When both your risk and reward are planned with precision, emotion loses its power, and consistency becomes your true edge. Let's bring everything together with a few quick examples so you can see how these ideas look in real trades. Imagine an uptrend where price pulls back to a strong structure level. You take a long entry, placing your stop below the last higher low. That's your 1R of risk. Price respects the zone, builds momentum, and hits the previous high. You take profit at +2R. One clean trade just paid for 2 normal losses. That's how professionals use math to win. Not by being right every time, but by keeping risk fixed and letting reward breathe. Now imagine the opposite. You short a breakdown in a weak market, but news hits and price spikes against you. It hits your stop. You lose 1 R, just as planned. No panic, no revenge trade, no moving the stop. You log it, take a breath, and wait for the next setup. Because you accepted the loss before entering, it doesn't damage your confidence. It's just one trade in a long series. The next valid setup appears, and you take it calmly. That's real consistency. Emotion-free repetition of a tested process. These examples might sound simple, but they show the biggest difference between amateurs and professionals. The amateur reacts to every result like it's life or death. The professional treats each trade as part of a larger probability game. They focus on discipline and controlled exposure, the real factors that keep the numbers in their favor. You'll find this mindset in almost every great trading psychology book. Mark Douglas, in Trading in the Zone, says real confidence comes when you stop expecting certainty from an uncertain market. The market doesn't owe you a win. It only offers probabilities, and your job is to manage them with discipline. Van Tharp expands on this with his work on R multiples and position sizing. He shows that measuring results in R helps you see clearly if your edge is working and keeps emotion out of performance. Both Douglas and Tharp share the same truth. You can't control outcomes, only behavior. And when your behavior aligns with the math of risk and reward, consistency follows. You might not win today, but over the series, the math takes care of you. That's the mindset you're building. Trading probabilities, not emotions. Now it's time to put this lesson into action. Knowledge means nothing if it stays in your head. It has to reach your trading routine. So here's a simple but powerful exercise that will help you start thinking like a professional risk manager. First, choose your fixed risk per trade. Keep it small, something between 0.25% and 1% of your account. Write that number down. If your account is $10,000 and you pick 0.5%, that means every trade risks $50. That's your 1 R. This number is your anchor. It defines how much you are comfortable losing without emotion. Next, pick one setup you already use. It could be a pullback entry, a breakout, a liquidity grab, anything you trade often. Go back to 3 recent examples on your chart and mark your logical stop and your logical target. Don't guess, use structure. Now measure the distance between them and express it in R. If your target is only 1 R, that setup may not be worth taking unless it wins a very high percentage of the time. If your target is 2 R or more, that's a healthy balance of risk and reward. The goal is to train your brain to see trades not in dollars, but in risk units. Then, create a short statement you'll say before every entry this week. Something like, I accept the full loss of 1 R on this trade. My stop is based on structure. My position size is correct. If I lose, I'll record it and move on. It might sound simple, but this sentence has power. It forces you to take ownership of your risk before you enter, and that habit builds emotional control. And finally, try this optional drill. It's called the coin flip exercise. Grab a coin and simulate 30 flips on paper. Every time you get tails, write down -1 R. Every time you get heads, write down +2 R. Track your running total as you go. You'll notice that even after several losses in a row, the total eventually turns positive. That's what probability looks like in action. You're not trying to win each flip. You're trusting the math across the series. That's the mindset you need as a trader. Do this exercise seriously for 1 week. It will rewire how you think about trading. You'll stop obsessing over a single outcome and start focusing on process, discipline, and consistency. And that's the foundation for everything that comes next. If there's one thing to take from this lesson, it's this. You can't control outcomes, but you can control risk. Once you accept that truth, the market stops feeling like chaos and starts feeling like a probability game. One you can finally play with confidence. From now on, start every trade with the same mindset. I know my risk, I've accepted it, and I'll follow my plan. When you think in R instead of dollars, fear and ego disappear. You stop trading to be right and start trading to be consistent. That's how professionals approach the market. Calm, disciplined, and patient enough to let the math work for them. Now we continue with the next chapter, Risk and Reward, Thinking and Probabilities, Part 2. In this chapter, the focus shifts to expectancy and the math behind consistency. You will learn how to evaluate trading performance using data, not emotions or isolated results. We will work with R multiples, win rate, and average return to identify your real edge. In Part 1, you built the foundation by accepting risk before entry, sizing positions correctly, and thinking in R instead of dollars. In Part 2, we take that logic further by calculating expectancy, tracking results across a series of trades, and using a simple performance tracker to support objective decision-making. By the end of this chapter, you will know how to evaluate whether your system is truly profitable and how to let numbers, not emotions, guide your trading decisions. Before we talk about consistency, there's something important you need to understand. Expectancy isn't about predicting the next trade. It's about knowing what your system is really worth over time. Most traders look at a few recent results and try to guess whether their strategy is good or bad based on that small sample. But professionals don't think like that. They know one trade or even 5 trades mean nothing. What matters is how their edge performs across a large series of trades. Expectancy gives you that answer. It tells you in simple numbers what your average result per trade really is. Here's the key idea. Expectancy is basically the math behind your edge. It shows how much you can expect to win or lose, on average, every time you follow your plan. And the formula is simple enough to say out loud. Your win rate times your average win minus your loss rate times your average loss. That's it. Just 4 numbers that tell the whole story. If that number comes out positive, your system has an edge and the math is in your favor. If it's negative, it doesn't matter how right your analysis feels. The system still loses over time. Let's make this practical. Imagine your strategy wins 40% of the time, and each win gives you 2R. When it loses, it costs 1R. Now plug it in. 40% times 2 minus 60% times 1. That equals plus 0.2R. In other words, your system makes an average of 0.2R per trade. If your risk per trade is $50, that's $10 of profit on average. It may sound small, but that's the essence of professional trading. Small, repeatable edges that compound through discipline and time. And that's where the real power of expectancy comes in. It moves trading out of the emotional world of hope and fear and into the logical world of math and probability. Once you know your expectancy, you stop guessing and start trusting the process. You stop thinking, I need this trade to win, and start thinking, if I keep executing my plan, the math will take care of me. That's where real confidence begins. Not in prediction, but in proof. To deepen this idea of expectancy and show how math governs long-term success, here's David Paul explaining the real challenge behind probability clusters and risk control.
And it's this clustering effect that makes playing the game so difficult, because you get long runs of good trades where you think you're God, and long runs, unfortunately, of bad ones where you feel like something that's under your shoe. Now, the first objective is to live through the clusters arithmetically that you don't go broke in them. Because you can quite easily have a cluster of 5 bad trades. 5 bad trades happen on a 50% system every 32. So if you were to bet 20% of your loot on any one particular trade, you go bankrupt every 5. The gist of all of this is that you should not risk any more than 1 to 2% of your kitty on any one trade. So if you've got 100,000 rand in your account and you're new to this, you should not risk any more than 1 to 2% of that in any one trade.
This perfectly connects expectancy to survival. It's not just about having an edge, it's about protecting it. By managing risk and accepting clusters of wins and losses, you let the math behind your system do its work. Now that you understand what expectancy really means, let's break down what creates it. Your win rate and your payoff ratio. These two numbers are like the engine and the fuel of your trading system. One tells you how often you win. The other tells you how much you win compared to how much you lose. Together, they decide whether your edge is strong, weak, or completely random. Your win rate is simple. It's the percentage of trades that end in profit. Your payoff ratio, also called the reward to risk ratio, shows how much you make on average when you win compared to what you lose when you're wrong. A high win rate feels good emotionally. But if your winners are too small, it can still destroy your expectancy. And the opposite is true too. You can win less than half the time and still make money if your winners are large enough to cover your losses. Let's look at a few examples so this sinks in. A trader who wins 70% of the time, but only makes 1 R when right and loses 1 R when wrong, has no real edge. Their expectancy is close to 0. Another trader wins only 40% of the time, but makes 2 R when right and loses 1 R when wrong. That trader has a positive expectancy. The math is simple, but the psychology isn't. Most people chase the comfort of being right instead of building a system that's actually profitable. That's why professionals don't care about being right on every trade. They care about how their average win compares to their average loss. They know a few big winners can pay for many small losses. So instead of asking, how often do I win? They ask, when I win, do I win enough? That single question changes everything. It forces you to think like a risk manager, not a gambler. The beautiful thing is you can balance the two sides. If your win rate is low, you can survive, even thrive with larger rewards. If your win rate is high, you can afford smaller ones. There's no perfect mix. What matters is that your combination of win rate and payoff ratio keeps your expectancy positive. Once you understand that relationship, you stop comparing yourself to other traders and start mastering your own numbers. That's the mindset that builds consistency, knowing your edge and playing it over and over without emotional interference. Even when your expectancy is positive, it doesn't mean your results will come smoothly. Real trading is full of streaks, clusters of wins and losses that can easily trick your emotions. You can have a system with a solid edge and still face 5 or 6 losses in a row. That's not failure. That's just variance, the natural randomness that exists in every probability game. This is where most traders fall apart. After a few losses, they panic, change their rules, or increase their position size to make the money back. But the professionals see it differently. They understand that variance is part of the process. Their goal isn't to avoid losing streaks, it's to survive them. And that's where proper risk management connects directly with psychology. Here's something to remember. The lower your risk per trade, the easier it is to stay calm during drawdowns. If you risk 2% per trade and lose 5 in a row, you're down roughly 10%. That's enough to mess with your confidence. But if you risk only 0.5%, that same streak costs just 2.5%. Uncomfortable, but manageable. Small risk keeps you emotionally stable and gives your edge enough room to appear. Professionals also set what we call loss boundaries. For example, they might stop trading for the day after losing 3R, or take a break for the week after losing 6R. These limits aren't about fear. They're about protecting focus and avoiding emotional overtrading. When your mind resets, your execution improves and your long-term curve stays healthy. So whenever you hit a losing streak, don't let your emotions take over. Step back, breathe, and remind yourself, a few losses don't define your edge. They're simply the cost of playing the game. Your only real job is to keep the risk small enough to stay in the game long enough for the math to work in your favor. That's how professionals turn patience into power. Now that you understand how variance affects your results, let's take the next step, tracking your expectancy in real time. This is where your trading turns from theory into measurable progress. Because no matter how strong your system looks on paper, if you're not tracking results in R, you're flying blind. Every professional keeps some form of expectancy tracker or journal. It doesn't need to be complicated, just consistent. You can use a spreadsheet, a notebook, or any app that feels natural to you. What matters is that after every trade, you record the same key details: the date, setup type, direction, result in R, win or loss, and your running total. Over time, this data reveals your true performance, not your feelings about it. When you record in R, you remove the noise of dollars and emotions. You're not saying, I made $150 today, or I lost $300 this week. You're saying, I'm up 3R this week, or I'm down 2R this month. It's clean, objective, and scalable. Whether your account grows or shrinks, 1R is always the same percentage of risk. That keeps your data consistent and your head clear. To make it even more powerful, you can add a moving expectancy line. For example, the average expectancy of your last 20 trades. When that line stays positive, you know your edge is alive and healthy. When it turns negative, it's a signal to review your system or execution. You're not reacting emotionally anymore. You're responding to information. And here's the best part. This simple habit builds confidence that no motivational video ever could. Because once you see in your own numbers that your system truly has a positive expectancy, the fear of short-term results starts to fade. You stop judging yourself trade by trade and start trusting the process you've proven with your own data. That's when consistency stops being a goal and starts becoming your normal. Let's turn this idea into something you can measure, what I call the 20 trade proof. Pick one strategy you already trade, not a new or experimental one. Then commit to taking 20 trades with that exact setup, following your rules precisely. Same fixed risk per trade, same stop logic, same way of taking profits. No skipping trades, no early exits, and no tweaking the plan mid-series. Every trade is just one data point in the bigger picture. Once you finish the 20 trades, calculate your win rate, your average win, your average loss, and your expectancy. Win rate times average win minus loss rate times average loss. That final number tells you the truth about your system. If it's positive, your edge is real and repeatable. If it's negative, that's not failure, it's feedback. It shows you exactly what needs adjusting. Maybe your targets are too tight, your stops too wide, or your execution too emotional. Either way, you've replaced uncertainty with information. This process does more than show you numbers. It rewires your mindset. You stop reacting to single outcomes and start focusing on the series. That's the shift Mark Douglas described when he said confidence comes from accepting uncertainty. You're no longer trying to win every trade. You're learning to let probabilities unfold across the series. And that's where consistency begins. To illustrate how discipline transforms trading from chaos to consistency, here's a practical lesson from David Paul, an experienced trader who emphasizes mechanical structure and persistence.
To build discipline, folks, you're going to have to grit your teeth and stick to the process. So the first step, put together your trading plan, a simple mechanical plan. The more mechanical, the better. And then my challenge to you folks is to follow that plan without deviation for a batch of somewhere between 20 and 30 trades. That's going to take quite a bit of doing. But to build a habit, okay, any habit, you've got to grit your teeth and do it. And then all of a sudden, everybody in this room is 8 to 13 trades away from the trader you want to be. That's all. But very few people get there.
This reinforces the idea that discipline is measurable. It's built through repetition, not motivation. Once you commit to a defined process, the numbers will start to tell your story. Now it's time to make this practical. Open your trading journal or create a simple spreadsheet. Add 5 columns: date, setup, direction, result in R, and notes on your mindset before and after the trade. Then log every trade for the next 20 entries. No skipping, no editing after the fact, no hiding bad results. When the series ends, review it honestly. Write down your expectancy result in bold. If it's positive, keep trading exactly as you have been. Discipline is now your main job. If it's negative, find the pattern. Are your stops too tight? Are you taking profits too soon? Let the data guide your next improvement. And to protect your focus, set a maximum loss limit. For example, minus 3R per day or minus 6R per week. When you hit that limit, stop trading and review. That's not weakness. That's professionalism. Do this once with full commitment, and you'll see what few traders ever do. Your real edge in numbers. You'll stop chasing the feeling of being right and start trading with calm, mathematical confidence. Because once you can prove your edge, you don't need to hope anymore. You just need to execute. Now we move into the next chapter, emotional management of losses and drawdowns. This is one of the most important skills that separates long-term traders from short-term survivors. In this chapter, the focus is on how to handle losing streaks without falling into emotional chaos or abandoning your process. You will learn what really happens inside your mind during a drawdown, why confidence fades, why control starts to slip, and how these reactions affect execution. More importantly, you will learn how professional traders stabilize themselves both mentally and strategically during these periods. We will also connect practical insights from Larry Williams with modern trading psychology, showing how experienced traders rebuild after losses and regain focus through structure, not emotion. By the end of this chapter, you will have a clear framework to protect your mindset during difficult periods, manage emotions under pressure, stabilize confidence, and return to trading with clarity and discipline after every setback. Now, let's start with something simple but real. Losses hurt, not just financially, but emotionally. When you lose money, it is not only your account that takes a hit, it is your identity as a trader. You start to question yourself. Did I do something stupid? Am I really cut out for this? That self-doubt is where emotional damage begins. Psychologists have shown that losing money activates the same areas of the brain as physical pain. That is why you do not just see a red trade, you feel it. It is a punch to your confidence. And when the pain of that loss stays unresolved, it does not just affect one trade. It infects the next ones too. That's why professionals treat emotional pain seriously. They know the real damage does not come from the loss itself, but from the emotion left unresolved. One unprocessed loss can lead to weeks of hesitation, revenge trades, or impulsive decisions. But when those emotional wounds pile up instead of healing, one losing trade hurts, but a series of them can shake even the strongest trader. A single red day is manageable, but when those losses start to stack, something deeper begins to unfold inside you. It is no longer about losing money. It becomes about losing confidence, rhythm, and identity. The spiral usually starts quietly. First comes frustration, then the urge to make it back. You stop seeing setups with objectivity and start seeing them as chances to erase the pain. Your focus shifts from reading the market to repairing your ego. You are no longer trading what is in front of you. You are trading what happened to you. The deeper this spiral goes, the harder it becomes to think clearly. Every tick feels personal. Every loss feels unfair. That is when trading turns into survival mode. Not analysis, not execution, just emotional defense. And if you do not stop it early, that spiral can erase months of progress in a single week. To understand this better, trading psychologist Brett Steenbarger explains why repeated losses are so difficult to accept, especially for high achievers who are used to success.
It is very difficult for someone who has succeeded consistently in other areas of their life to enter a performance arena where you're going to be wrong 50% or more of the time. So in college and school, I had a grade point average where all my grades were A's or B's. And that's what allowed me to get to graduate school and be successful academically. So I never had a quote unquote failure. In trading, I have many failures. There are many losing trades. And if you can't accept it and use it constructively, it can really tear you down.
Brett Steenbarger reminds us that one of the hardest adjustments for high achievers is accepting that in trading, being wrong half of the time is completely normal. Frequent losses may feel like failure, but in markets, they are simply data points that carry information. Authors like Carol Dweck and Mark Douglas show that professionals reframe losses as feedback, not defeat. Trying to avoid them only leads to denial, overtrading, and eventually bigger damage. True professionals accept losses as part of their edge. They use risk management and consistency to turn probabilities into long-term profitability. Acceptance turns pain into clarity, and that shift breaks the spiral. Next, trader and mentor Francis Hunt explains how predefined structure during trade management prevents emotional traps once emotions begin to rise.
So in trade management, that's the part that you do once you're already entered. To me, that's the part when you're least mentally stable because you've expressed a view and you will only tend to see, psychologists have shown, we tend to see the view if I give you two pieces of fundamental information, one that's bearish for your case and one that's bullish, and you've bought the share, you superimpose the significance of the bullish one at the expense of the bearish one, and that is psychology, because you're trying to combat a cognitive dissonance in your own mind. So there's something that's upsetting you there and there's something that's pleasing you, and you'll say the one's more important and overrules the other. So you need to have specified in your stop, your entry and your take profit at the point of placing the order. And that's usually a pending order. In other words, the market comes and gets me and this trade only becomes live if it does what I expect it to do and it runs a key level. If it doesn't, I'm totally happy and I will take the order away and it can fall, do whatever else it was going to do, and I just say my view and all the research I did was incorrect, and let's find another place where we can try again. So the in-trade management, the Hunt volatility funnel trading strategy reduces the pressure on in-trade management. Most people have pressure on in-trade management because they've never thought about their stop until they've already expressed the fact that they want to buy a market that they think is going up. And that's why they now have a stressful in-trade management. They've never thought when it's in money at what level they'd be happy to get out. And so the lowest common denominator is your emotions. So greed keeps you in, pain gets you out. Simple.
Structure replaces impulse. With clear stops and targets defined beforehand, execution stays clean and the mind stays steady. So how do professionals stop the emotional spiral before it takes over? They reset completely. The difference between a struggling trader and a consistent one often comes down to how fast they can hit the reset button after a drawdown. The first step is acceptance. You have to stop fighting reality. The losses happened. They're not a reflection of your worth. They're part of the statistical nature of trading. The more you resist, the more pain you create. Acceptance doesn't mean giving up. It means freeing your mind from denial so you can see clearly again. The second step is reducing risk. Professionals don't fight fire with fire. They fight it with control. That might mean cutting position size in half, pausing live trading for a few sessions, or focusing on chart review instead of execution. You're not retreating. You're rebuilding your foundation. Then comes reflection. Write down what happened, what triggered the spiral, and which emotions dominated your decisions. But don't relive the traits. Reflection is not punishment, it's observation. You're studying behavior, not judging it. And finally, reset your body. Physical tension fuels emotional chaos. Walk, exercise, breathe deeply, sleep well. A calm body regulates a calm mind. That's why top traders protect their physiology as seriously as their capital. Because you can't trade well from a stress state. Resetting the body resets the mind. So once you've reset, the goal isn't to make the money back. It's to rebuild your rhythm. Confidence doesn't return all at once. It grows in small, consistent steps. Professionals understand that recovery is a process, not an event. You don't bounce back overnight. You rebuild by proving to yourself that you can execute again. Start small. Lower your expectations and focus on process, not outcome. One good trade, executed with discipline, is more powerful than a week of emotional overtrading. Every time you follow your plan, even if the trade loses, you rebuild a piece of your confidence. Over time, those small proofs stack up and form the foundation of trust in yourself again. Brett Steenbarger teaches that recovery isn't about motivation. It's about structure. When you go back to your habits, your pre-market preparation, journaling, emotional check-ins, you start to feel in control again. Structure brings rhythm, and rhythm brings calm. That's when your mind stops chasing results and starts respecting the process. To reinforce that recovery grows through structure and learning, Brett Steenbarger explains how resilience increases when we treat losses as information.
What gives you the resilience is that you're treating losses as learning experiences. And because you're not erasing the memory of it, you want to remember, let's say a bad trade, a trade that goes wrong. You want to remember it because you want to learn from it. In that sense, you're embracing the losses. Now that, of course, presumes reasonable risk management, okay? But if you are making a good bet, betting this amount to make this amount, and it goes wrong, you can try to identify what might I have done differently, what did I miss, and so now the loss is not so threatening. It's there to make you better. Resilience helps us traverse our learning curves. We're going to make mistakes, and even the best traders are often wrong close to 50% of the time. We want to use losses to make us better, not to tear us down.
Use structure to turn setbacks into feedback. That keeps execution steady and lets confidence return step by step. When that flow returns, something shifts. You stop reacting and start responding. The same market that once broke your confidence becomes the tool that rebuilds it. Because flow isn't about avoiding losses. It's about staying emotionally steady, no matter what the outcome is. Now that you understand the emotional mechanics of a drawdown, let's make it practical. Every professional trader has a rule that protects them from emotional overload. One of the simplest and most effective is called the 3-loss rule. It's not about the number 3 itself. It's about recognizing when emotion starts to replace logic. Here's how it works. If you lose 3 trains in a row, you stop. No one more try. No, let me make it back. You step away. That's it. Don't try to make it back, just don't wait. Understand, even if you still see setups on the chart, that pause isn't weakness, it's awareness. It's the point where professionals protect their mind before protecting their money. During that pause, don't analyze charts. Analyze yourself. Open your trading journal and ask 3 questions. First, what emotion dominated those trades? Take a moment to name it clearly. Fear, frustration, revenge, or maybe exhaustion. When you can name the emotion, you take away part of its control. Awareness is the first step toward regaining balance. Second, was I following my plan or reacting to pain? Be brutally honest here. Sometimes we think we're being disciplined, but deep down, we're just trying to fix the feeling of losing. Recognizing that difference helps you separate logical trading from emotional trading. And third, what do I need right now? Rest, clarity, or distance? Each answer leads to a different kind of reset. Rest helps your body recover. Clarity helps your mind realign, and distance helps your emotions settle. Those questions shift your focus from punishment to recovery, from blaming yourself to learning from yourself. It's not about perfection. It's about awareness. And awareness is what turns a losing streak into a lesson. This simple habit prevents a bad day from turning into a bad week. It builds emotional discipline and creates a buffer between you and the chaos of the market. The traders who survive long-term aren't the ones who never fall. They're the ones who know exactly how to stop the fall before it becomes a crash. So this week, I want you to create your own 3-loss response plan. It's simple, but powerful. Write down exactly what you'll do if you lose 3 trades in a row. Be specific. Will you stop trading for the day? Review your journal? Go for a walk. Reduce size on your next session. Build a short, written checklist that helps you pause before emotion takes over. The goal is to replace panic with a plan. When your brain knows there's a clear routine to follow after a loss, it stops treating every losing streak as danger and starts seeing it as data. That's how professionals keep their composure even in the worst weeks. Remember, emotional control doesn't come from suppressing feelings. It comes from knowing exactly what to do when they appear. And the most important thing you need to understand is that losses are inevitable, but emotional collapse is optional. Every trader goes through drawdowns. What defines your future is how you respond to them. When you accept losses as part of the game, they lose their power over you. You start to think clearly, act deliberately, and trade with confidence again. The traders who survive are not the ones who never fall. They're the ones who know how to rebuild themselves every time they do. Now we move into the next chapter, routine, preparation, and mental performance. This chapter focuses on the foundation that keeps your mind sharp and your emotions stable before the trading day even begins. You will see how daily habits directly shape focus, discipline, and decision-making. Preparation is not only about charts or analysis. It is about building the physical and mental energy needed to stay calm, present, and consistent under pressure. Trading performance starts long before the first trade is placed. In this chapter, you will learn how professional traders approach routine as part of their edge, treating trading as a mental sport where mindset, recovery, and preparation matter as much as strategy. By the end of this chapter, you will know how to build a simple pre-market routine, create a mental warm-up that keeps you centered, and develop habits that support consistent performance in every session. Now let's start by talking about something most traders overlook: routine. Every morning, before a single candle forms, your mind is already deciding how you'll trade. Your habits, your energy, and your emotions set the tone long before you open the platform. Most traders think preparation means checking charts, reading news, or marking levels. But real preparation begins much earlier, with how you wake up, breathe, and center your mind. If you start the day rushed or distracted, you're already trading from weakness. When you skip your routine, you give the market control over your state. One losing trade will shake you. One sudden move will trigger panic, because without mental structure, emotions take over faster than any stop loss can save you. Think of your routine as your warm-up before the game. An athlete never competes cold. They stretch, breathe, and build focus before the first move, because they know performance begins long before action. A simple, consistent morning routine builds internal stability. You don't need anything fancy, just a structure that reminds your mind who's in control. And when your mind is centered, your trading naturally follows with clarity and confidence. To illustrate what a professional trader's preparation looks like in real life, here's Linda Raschke, a seasoned market veteran, sharing how she starts every trading day with structure, focus, and discipline.
Well, first of all, I always try to have my homework done the night before, my plan the night before, and then, of course, first thing I'll do when I get up is usually check the markets just to see where they're trading so I can get a baseline reading. Two things. First of all the opportunity comes in the morning sessions, and you know, I usually start at 6 a.m. Central Time. So 7 a.m. Central Time is a big pickup in activity in the markets. So if I'm watching it a little bit beforehand, it helps get a feel. Also, when you're trading, it's a performance-oriented discipline. So the more you can eliminate distractions and get yourself into a ritual or groove right away, I think you're better able to concentrate. And that's really the key, is being able to concentrate right off the bat. And the more you can do something consistently the same way, the easier it is to slip into that zone, if you will. So for me, it's always important that I eat a big breakfast. I always have a giant bowl of oatmeal or a couple eggs, and you know, that really only takes 5 minutes. But you got to fuel the body and got to fuel the brain. That's so important. People sit there and think they're going to make it on a bagel or something, and it just doesn't work that way. So it's really important to have some good nutrition, and just make sure you're in a calm space. You've got your stuff around you, your trade sheet or your game plan, and just not try to think about too much of anything. You know, you don't want to go so crazy drinking coffee or something. You're going to have to run to the bathroom right after the opening bell, you know. So I think everybody kind of finds their own routine for themselves. But do eat a good breakfast. Do have your homework done the night before. Try and have a space where you're not going to be distracted, or kids knocking on the door, or phones ringing, or that type of stuff.
This example reinforces how preparation is not just about charts, but about conditioning your body and mind for performance. Now, let's go deeper into what real preparation looks like, because it's not just about what you do before trading, it's about how you feel when you start. A calm, focused mind sees the market clearly. An anxious mind only sees threat and chaos. Sleep is your first performance tool. If you trade tired, your brain operates in survival mode, making emotional shortcuts and impulsive choices. Good sleep isn't a luxury. It's part of your trading system. Next comes your physical state. A few minutes of movement, stretching, or breathing before the session can reset your entire nervous system. That's how you tell your body, we're starting fresh, not carrying yesterday's stress. Then, prepare your mind. Spend 5 quiet minutes reviewing your plan, visualizing execution, and reminding yourself of your rules. This small ritual builds confidence, sharpens attention, and protects you from emotional overreaction. Remember, you can't control the market, but you can control the state you bring into it. Preparation isn't about perfection. It's about entering each session with emotional stability and mental readiness. That's why elite traders treat preparation as non-negotiable. Their focus is trained, their mindset is grounded, and their routine runs automatically. They don't wait to feel ready, they prepare to be ready. To reinforce how preparation and repetition turn into true discipline, here's trader and coach David Paul explaining why following a structured process is the real foundation of consistency.
To build discipline, folks, you're going to have to grit your teeth and stick to the process. So the first step, put together your trading plan, a simple mechanical plan. The more mechanical, the better. And then my challenge to you folks is to follow that plan without deviation for a batch of somewhere between 20 and 30 trades. That's going to take quite a bit of doing. But to build a habit, okay, any habit, you've got to grit your teeth and do it. And then all of a sudden, Everybody in this room is 8 to 13 trades away from the trader you want to be. That's all. But very few people get there.
This shows that discipline doesn't appear overnight. It's trained through repetition and structure, just like any other skill. Now that your body and mind are prepared, let's talk about what happens once the market opens. Your mental performance. This is where focus, emotional control, and decision-making come together. In trading, every click reflects your mental state. If your thoughts are scattered, your trades will be too. The goal isn't to eliminate emotions, but to stay aware of them. When you notice frustration, fear, or excitement rising, that's your signal, not your enemy. Awareness creates distance between what you feel and what you do. The more you can observe your emotions without reacting, the closer you get to true control. This is what psychologists call the flow state, a mental zone where your mind is fully engaged, time feels slower, and decisions flow naturally. Traders who reach this state aren't forcing focus. They've created the conditions for focus to happen. Preparation, calm breathing, and trust in their process allow them to stay in that zone longer. But here's the truth. Flow doesn't come from luck or motivation. It comes from routine. You can't control the market, but you can train your mind to enter a performance state through repetition. Every consistent pre-market ritual teaches your brain, this is trading mode. Over time, that association becomes automatic. When you trade from that state of focus, you see the market differently. Noise becomes structure. Fear turns into information. And instead of reacting to every candle, you start responding with intention. That's the difference between chasing trades and executing with precision. Mental performance isn't about intensity. It's about balance. The more you protect your focus, the more your performance protects you. Let's turn this lesson into action. Your exercise for this module is simple, but extremely powerful. For the next 7 days, create a 10-minute pre-market routine, a personal ritual that prepares your mind and body before you open your charts. Start with the basics. Wake up at a consistent time, drink water, and move your body. Even a short stretch counts. Then take a few slow breaths and write down your trading plan for the day. Review your key levels, your rules, and your emotional goals. Ask yourself one important question. What kind of trader do I want to be today? Remember, these 10 minutes are not about predicting the market. They're about preparing yourself for it. Over time, you'll start to notice something. Your focus will sharpen, your decisions will slow down, and your reactions will become calmer. That's your preparation working for you. More importantly, professional traders don't rely on motivation. They rely on structure. They've built systems not just for their strategy, but for their state of mind. And when you take care of your mental performance, the quality of your trading naturally improves. So make this commitment to yourself. Treat your preparation as your first trade of the day and make it a winning one. Now we move into the next chapter, trading journal and feedback loops. In this chapter, we focus on one of the most powerful tools for long-term improvement in trading, your journal. This is not about logging numbers. It is about creating a feedback loop between actions, emotions, and results. You will learn how to turn your journal into a performance tool that helps you identify emotional triggers, recurring mistakes, and behavior patterns that affect consistency. We will also explore how professional traders and coaches like Brett Steenbarger use journaling as psychological training, turning experience into insight and mistakes into growth. By the end of this chapter, you will know how to build your own trading journal, analyze it effectively, and use feedback loops to refine both your strategy and your mindset over time. Now, let's start by talking about something most traders overlook: reflection. Many spend countless hours studying charts, strategies, and indicators, but only a few take the time to study themselves. The truth is, your trading performance doesn't just come from technical skill. It comes from understanding your own behavior, your reactions, and the emotions that influence every decision you make. A journal bridges that gap. It turns trading from a series of random outcomes into a process of continuous learning. When you write down what you saw, what you felt, and why you acted, you begin to notice the patterns that cause your results to repeat. Suddenly, your mistakes stop being mysterious. They become data. Think about it this way. Every trade carries two kinds of information. One is market feedback, price action, structure, entries, exits. The other is mental feedback, fear, confidence, hesitation, frustration. Most traders only track the first, but the second one is what truly defines consistency. Mark Douglas often said that trading is a mirror that reflects your beliefs. The journal is how you polish that mirror. Without it, you stay blind to the hidden forces driving your decisions. With it, you finally start to see yourself with clarity, and that's where real growth begins. Now, let's talk about how to actually build a trading journal that works. One that feels useful, not like homework. A lot of traders make journaling harder than it needs to be. They open a huge spreadsheet, fill it with numbers, and after a few days, they quit. And I get it. If your journal feels like a chore, you won't keep it up. The real goal is not to collect endless data. The goal is to create awareness. Your journal should tell the story of each trade. Not just what you did, but what was happening inside you when you did it. Think of it as a short conversation with yourself. After every trade, you can keep it very simple. For each trade, write 4 things. First, what you planned, your setup, your reason for entering. Second, what actually happened, how the trade played out. Third, how you felt during the trade, maybe anxious, confident, impatient, or calm. And fourth, what you learned. What would you do differently next time? That's all you need to start. You can do it on paper, in a notebook, in Notion, or even a Google Sheet. The format doesn't matter. What matters is honesty. This isn't about looking smart. It's about seeing the truth. As you keep doing it, you'll start to notice patterns. Maybe you always overtrade after a big win. Or maybe you close early when you're scared to lose profits. These patterns are invisible on your chart, but they become crystal clear in your journal. And once you see them, you can start to change them. Because awareness is the first step to discipline. Dr. Brett Steenbarger, one of the leading voices in trading psychology, explains that developing awareness isn't just about emotions. It's a cognitive skill. Great traders train their minds to think in 2 ways, fast and deep. This dual awareness is what allows them to recognize patterns and evolve through reflection.
What we found cognitively was that great traders are either greatly fast thinkers or greatly deep thinkers. And it's a little bit like Daniel Kahneman's idea of thinking fast and slow, the book that he wrote on that topic. And to think fast means rapid pattern recognition. It means looking at things broadly and seeing many different things at one time and seeing the pattern to those. Thinking deeply means that you're gathering a great deal of information, doing a great deal of research, and understanding something in more depth than the average market participant. Both of those require sustained concentration. They are different cognitive functions, thinking fast and thinking deeply, but both require that we sustain attention to find the patterns and to dig in research to generate conclusions.
That's exactly what journaling helps you build. The mental focus to see patterns in real time and the depth of reflection to understand what drives them. Awareness, when practiced deliberately, becomes a true trading skill. Now that you understand how to journal, let's talk about the real magic behind it, the feedback loop. A feedback loop is simple to understand, but incredibly powerful. It's the process of acting, observing the result, learning from it, and adjusting your behavior for the next round. It's how athletes improve. It's how musicians master their craft. And it's exactly how professional traders evolve. When you make a trade, that's your action. When you review your journal afterward, that's observation. Then comes the lesson. What worked? What didn't? What emotions got in the way? Finally, you apply those lessons to your next trade. That's the adjustment. And that full cycle, repeated over and over, is what turns experience into skill. The key is to review your journal regularly, not just once in a while. Set a time, maybe every weekend, to sit down and go through your trades. Look for patterns, both good and bad. Ask yourself, what am I doing consistently well? And where am I still reacting emotionally? This process turns every mistake into information and every frustration into progress. Instead of being angry about a losing week, you start to see it as data, as part of your evolution. That shift in mindset is what separates the emotional trader from the professional one. As trading psychologist David Paul often says, discipline isn't something you're born with, it's something you build. In this clip, he explains how consistent repetition and structured routines help traders transform awareness into habit and habit into mastery.
I think that you can build discipline in any field that you want to sort of work at. It takes repetition, I go to the gym every day. I have absolutely no idea why I go to the gym every day at 61, but nevertheless, it doesn't take any discipline for me to go to the gym every single day. And the great paradox, of course, is that when you've got discipline, you don't need it. So it just happens. You can build discipline relatively easily, and in some of the training courses I've done over the years, we have a discipline building exercise, which is all about gritting your teeth and following a trading system for about 30 trades. It takes about 30 trades to instill that discipline. And I'm reasonably disciplined in most things. There are certainly things that I need to work on, that's for sure. But I firmly believe that anybody can develop the discipline to be a consistently winning trader, but very few do.
And that's the essence of the feedback loop. Repetition with awareness. When you apply reflection consistently, discipline becomes automatic. You stop forcing control and start living it. Now let's make this real with an example. Imagine a trader named Daniel. He's been trading for 2 years, and his biggest struggle is revenge trading. Every time he takes a loss, he feels the need to make it back immediately. Sometimes he wins, but most of the time, he ends up making things worse. At first, Daniel didn't understand why this kept happening. He thought it was just bad luck or bad timing. But when he started journaling, he noticed a clear pattern. After every loss, he felt a rush of frustration and pressure to prove himself. His notes showed that these emotional trades were always impulsive, taken too fast, with poor setups, and no plan. By writing it down, Daniel turned something emotional into something visible. It wasn't just a bad day anymore. It was a behavioral loop. He could see it on paper. That's the power of journaling. So Daniel made one small rule. After any losing trade, he would step away for 10 minutes before taking another. He kept tracking this rule in his journal. Over time, his emotional losses dropped sharply and his win rate improved. Not because his strategy changed, but because he changed. This is how journaling transforms your performance. It gives you the evidence you need to break emotional habits. It turns self-criticism into self-awareness, and that awareness becomes control. Every professional trader you admire, whether it's Brett Steenbarger's students, Mark Douglas's followers, or Larry Williams himself, has a method of feedback. Some write, some record voice notes, some review charts, but they all do the same thing. They learn from themselves. So, if you ever feel stuck, inconsistent, or emotional in your trading, the answer isn't always a new indicator or strategy. Sometimes, it's as simple as listening to your own patterns. And your journal is the microphone. All right, now let's put everything into action. This week, your task is to build your own trading journal and start using it as a real feedback tool. You don't need anything fancy. You can use a notebook, a spreadsheet, or even a Notion page. Whatever feels easy and natural for you. What matters is that you actually use it after each trade while the emotions are still fresh. Here's a simple structure you can follow. Start with what you planned. Write down the setup you were trading and why you decided to take that trade. Then, note what actually happened, how the trade played out compared to what you expected. Next, describe how you felt before, during, and after the trade. Were you calm, anxious, confident, or frustrated? And finally, write down what you learned. What would you do differently next time? Once you've done this for several trades, take a moment at the end of the week to review everything. Don't just look at profits and losses. Look for patterns. Ask yourself, when do I tend to break my rules? Or what kind of setups make me feel most confident? The goal here isn't to judge yourself, it's to understand yourself. When you see your behavior written down, it's easier to connect the dots and make small, meaningful improvements. And here's the key. Pick one small change to focus on next week. Maybe it's taking a 5-minute break after a losing trade. Maybe it's checking your emotional state before each entry. Keep it simple, but stick to it. This process doesn't take long, maybe 5 minutes per trade, but the impact builds over time. You'll start noticing that your decisions feel calmer, your reactions slower, and your awareness sharper. And that's how consistency is built. One reflection, one lesson, one journal entry at a time. As we finish this chapter, remember, journaling isn't just about writing things down. It's about awareness. Your journal becomes a mirror that shows you what the charts can't, your emotions, your habits, and your growth. Each entry makes you a little more conscious, a little more disciplined, and a little more consistent. Over time, those small reflections compound, just like profits do. So make journaling part of your routine. Treat it as your daily conversation with yourself as a trader, because awareness creates discipline, and discipline builds consistency. Now we move into the final chapter, building your personal trading psychology framework. This chapter brings everything together. All the lessons, insights, and mental skills you have developed throughout this course are combined into one clear and practical framework. Awareness, discipline, emotional control, and structure are no longer separate ideas. They work together as a single system. In this chapter, you will see how emotional control, routine, risk management, and journaling connect into a continuous loop of preparation, execution, and review. This is how psychology becomes something you apply daily, not something you think about only after mistakes. By the end of this chapter, you will know how to prepare with intention, execute with discipline, reflect with honesty, and improve consistently over time, turning trading psychology into your most reliable edge. Now, let's start by going back to where this journey began, the mind. In our first chapter, we learned that your mind can be your worst enemy or your greatest ally. That idea became the foundation for everything else. Awareness is always the first step toward control. You can't change what you don't see. When you started, the market felt like chaos, every candle a test of emotion. But as you understood fear, greed, and discipline, something shifted. You began to notice patterns, not only in price, but in yourself. That's when growth really started. The difference between amateurs and professionals isn't knowledge, it's awareness. Professionals sense when impatience, greed, or fear are rising, and instead of fighting them, they breathe and respond with structure. That's the true transformation. When you stop reacting to every tick and start observing with calm focus. Every great decision begins from that awareness. At this point, let's talk about mastering emotions, not by suppressing them, but by understanding them. Fear, greed, and excitement aren't enemies. They're signals showing where your focus and attachment lie. The goal isn't to erase them, but to listen without letting them control you. Fear comes from trying to control uncertainty, and greed comes from wanting more than the market offers. Both tied to survival instincts that don't belong in trading. Professionals treat emotions like they treat structure, with discipline and observation. Fear means risk feels too high. Euphoria means confidence is turning reckless. They notice early and act with structure, adjusting size, following checklists, or taking breaks. Emotional mastery isn't about not feeling. It's about not reacting. You learn to accept uncertainty and act with logic instead of impulse. When awareness is strong and your process clear, no emotion can pull you from discipline. That's real control from the inside out. Then come the three qualities that shape every successful trader: discipline, patience, and consistency. They're not talents. They're trained, one decision at a time. Discipline keeps you aligned with your plan when emotions try to take over. It's the muscle you build every time you respect your stop or skip a setup that doesn't fit. Patience protects you from chasing the market. It's active restraint, the ability to wait calmly while probabilities align. Consistency is what happens when discipline and patience work together. Anyone can follow rules for a few days. Professionals do it month after month. They know no single trade defines them. The series does. As Mark Douglas taught, the market seems random in the short term, but consistent behavior creates consistent results. That's why discipline, patience, and consistency aren't optional. They're the foundation of every lasting edge. So let's go deeper into one of the most powerful lessons in this course, identity. How you see yourself as a trader shapes every choice you make. If you see yourself as a gambler, you'll chase moves and break rules. But if you see yourself as a risk manager, your focus shifts from making money to protecting capital. You start thinking in probabilities, not predictions. You stop asking, will this trade win? And start asking, does it fit my plan? Identity decides how you handle risk and pressure. That's why Mark Douglas said consistency begins with thinking in probabilities. The risk manager doesn't judge one outcome. He trusts his edge over time. This mindset frees you. You stop needing to be right and start needing to follow your process. Professionals think in R, not dollars. They accept losses before entering and measure success in series, not single trades. Their calm comes from discipline, not results. The real question isn't, did I make money? It's, did I act like the trader I want to be? Then comes the real test of mindset, losses and drawdowns. No matter how strong your system is, the market will always test your confidence. A losing streak doesn't just hit your account, it shakes your identity. But professionals know losses are inevitable. Emotional collapse is optional. Recovery starts with acceptance. You stop resisting and treat losses as feedback, not failure. As Brett Steenbarger says, resilience comes from learning, not avoiding pain. Next comes structure. Professionals don't try to win it back. They reset. They reduce size, pause, review, and rebuild rhythm slowly. It's not weakness, it's discipline. The 3-loss rule helps. After 3 losses, step away, breathe, and analyze your mindset. That break protects both capital and clarity. Resilience isn't about never falling, it's about rising with structure. Consistency isn't built from perfection, but from the ability to reset and move forward. At this stage, let's talk about one of the most underrated tools in trading, your routine. Consistent results begin with consistent preparation. Performance doesn't start on the chart. It starts with how you sleep, breathe, and prepare. If you start the day rushed, you're already trading from weakness. Your morning routine is your first trade, the moment you focus your mind and regulate emotion. As Linda Raschke says, discipline begins before the opening bell. Preparation isn't about perfection. It's about emotional stability and readiness. A few minutes of breathing or reviewing your plan creates calm focus. Over time, repetition builds flow. That state where decisions feel natural and time slows down. Flow doesn't come from motivation. It comes from structure. When routine becomes habit, calm becomes your default. The market doesn't reward emotion or speed. It rewards clarity, patience, and presence. And those are built long before you click the button. So let's finish with the final piece that turns awareness into mastery, journaling and feedback. Larry Williams once said, "The best trading book you'll ever read is the one you write yourself." Every trade you record, every emotion you describe, every lesson you capture becomes part of your evolution. Your journal isn't just notes. It's your mirror, your mentor, and your map. Journaling turns trading from random outcomes into continuous learning. Each entry links what you did with what you felt, revealing patterns no chart can show when you're focused, distracted, or emotional. Awareness turns mistakes into data, and data into growth. That's the essence of feedback. Act, observe, learn, adjust. It's the same cycle every professional follows. Repetition with reflection. The secret is consistency. Review your journal weekly. Study both results and emotions. Ask, where am I disciplined? Where am I reactive? Each answer sharpens your edge. Because mastery isn't avoiding mistakes, it's learning from them. When you study yourself, you stop trading blindly and start evolving consciously. Your journal becomes the bridge between who you are and who you're becoming. So now it's time to bring everything together: awareness, emotion, discipline, identity, and reflection into one clear system you can follow every day. This is your personal trading psychology framework. It starts with awareness, noticing what's happening inside you as clearly as what's happening on the chart. Awareness turns reactivity into observation. Then comes structure, your plan, your routine, your preparation. Structure gives your emotions direction and keeps chaos in check. Next is execution, following your plan with patience and discipline. You're no longer chasing trades, you're managing probabilities with intention. After that comes reflection, journaling your actions, emotions, and lessons. This keeps your progress visible and your awareness sharp. And finally, adaptation, using feedback loops to refine your mindset and process over time. This is how you evolve from experience, turning every mistake into information and every week into improvement. Together, these 5 elements form a mental ecosystem, one that protects your focus, strengthens your discipline, and builds true consistency. You don't need perfection. You need a framework that keeps you growing trade after trade. Because trading psychology isn't about control, it's about alignment. When your thoughts, actions, and emotions work together, you stop fighting the market and start flowing with it. To make this framework real, let's turn it into action. Your exercise for this final chapter is to create a 30-day psychological growth plan, a simple roadmap to apply everything you've learned. Start by choosing 3 specific mental goals you want to develop over the next month. For example, manage frustration after losses, strengthen your daily routine and focus, journal consistently after every session. Then, write one daily action for each goal. Keep it small and realistic, something you can repeat. Maybe you'll take 2 deep breaths before every entry, review your journal each night, or pause for 5 minutes after a loss. At the end of each week, take 10 minutes to review your progress. Don't judge, observe. Ask yourself, where did I stay disciplined? Where did emotion take over? What can I adjust next week? By the end of 30 days, you'll notice subtle but powerful changes, calmer reactions, sharper awareness, and stronger consistency. Because improvement in trading psychology isn't built in one big leap. It's built through small, deliberate steps repeated over time. This plan is your next level, your way to keep training the mind that controls everything else. So as we end this journey, remember, you don't master the market, you master yourself. Every trade and emotion you faced has shaped the trader you're becoming. Real success isn't about predicting price. It's about managing your mind, your risk, and your reactions. The market will always test you, but now you have what most traders don't: awareness, structure, and a framework that keeps you grounded under pressure. Consistency isn't luck. It's the reflection of who you are when things get tough. Each day you apply awareness, discipline, patience, and reflection. You strengthen your identity as a true professional. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.